Jobs numbers are kind of really the only missing link though. Like we kind of have the whole market has a good sense of what's happening with growth. I think it's very evident that there's a growth slowdown now, but I think what's missing now is unemployment going to rise? Is the Fed able to cut rates with rising unemployment? Because that's pretty much the reason that they're waiting for. Even though the market's thinking, okay, growth is slowing down, our system's picking up a growth slowdown, the Fed is waiting for unemployment to rise. I don't think they're going to cut rates, at least meaningfully, until unemployment starts rising.
Well, yeah, obviously they're going to also want inflation back down to target, right? So it does look good for on the inflation front. I mean, if you look at just commodities by themselves, it does look promising that in the next, if this pace continues in the next few months, inflation should be much closer to target than what is to be expected. I mean, we can just check something like, let's see, like let's just check the Cleveland Fed and inflation nowcasting here. We can see that for March we're at 2.47, right?
Yeah. Like what
So
happened to those tariff is inflationary calls? What happened to all of that? That seems like it was completely wrong. And I think especially today with Trump coming out and saying they're not going to be tariffing uh, pretty much a lot of certain items, which for Canada, crude oil is falls into that bucket that they're not going to be tariffing. So that just kind of crushed crude oil.
yeah, so with crude oil, I think that with oil in general, I think the key that we have to look at here is just on a general price perspective, where is oil? And oil is pretty much going down to levels not seen since almost before the Ukraine war broke out. And I think the basic view on this is oil down here and lower is only going to accelerate disinflationary effects that eventually bleed into the rest of the economy, right? Because yes, services are anchored and lagging. I understand that, but energy goes down, commodities go down, everything else will follow thereafter, type of thing, right? So I think that as long as crude is at these levels and possibly lower, the fear of inflation is something that has to take the back seat. And I posted this earlier today, but I think like we're at the we're I don't think I'm pretty much almost certain that we're at this point now where NFP or payrolls and job growth is going to be way more important than CPI. I don't think CPI is going to have the relevance that it did. We've been weaning off that relevance the last couple of months, but coming into this whole post-election thing, we saw a CPI rise from, we'll take a look right here, right? So we had inflation bounce from, I think it was 2.2? Yeah, it was 2.4. We saw it come all the way up to 3%, and we're expected to go back to 2.4 again by March at the current indications of what we're seeing in the economy. So I think like we've been pretty adamant that this entire rebound in inflation is pretty much just a fadeable bounce. Like this, I don't know how loud we've been, but I'm pretty sure it's been louder about the disinflation trend. We've been saying that it's not going to stop, and I don't think disinflation was over. I think or is over. I think what happened is once the odds accelerated that Trump was going to win the election, the market pulled forward a lot of tariff front running, which we've seen in the data. You can look at GDP now for that, and it shoved prices up a little bit short term. And I think that that's what this bump in inflation was.
Yeah.
Realistically, I think that created this extreme break in disinflation. But I think we do continue to see disinflation. So I don't think, again, inflation is to be an issue. In my opinion, inflation is going to be an issue if we could hold above 3%.
Yeah.
Without that, this is all noise. As long as inflation doesn't hold above 3%, or I should say, as long as inflation holds above 3%, it's something problematic. We had one print here above 3. I think once we get below and trend lower, it's all going to be inflation's just noise at that point. The most important thing is going to be payrolls. And tomorrow, or when this will be released Friday, so before NFP, we're seeing estimates of $160,000, 160,000 jobs being created in the month of February on NFP. The issue here is obviously this is all wildcard number. The estimates are wide on this, and no one really knows what is going to happen with labor, given the administration's, presence of or the Doge presence in the administration, and everyone trying to optimize their own, the private sector trying to optimize their companies. Everyone's trying to get. You're at this phase in the market now where, or in the economy where, um, people can optimize margins, or they're almost forced to optimize margins by laying off people, right? And that's more of the later stage of things. Not to say that that means we're going into a recession, but um, there's also a lot of companies that take inspiration from the government, right? Like they see, for example, Twitter, right? If you look at what happened, or X now, if you look how Elon came in and took over the company and fired a large part of the company, and it still functions fine. There are lasting effects of success stories like this that will motivate some business owners to think that they're overstaffed and they can optimize their workforce. We're seeing it happen now with Doge in the government. So again, everyone's being told like, okay, we can run more efficient companies with less people. And how that bleeds over to some private sectors depends on the company, depends on the political views of the people running those companies and whatnot. But there's obviously going to be um, some sort of influence with this. So I think that that's probably where we're going to have to focus on going forward, and I think that's going to hold the spotlight. I don't think inflation is
Yeah.
really something we have to worry about.
Like I think the market's well aware of that too. Like the Fed has a dual mandate, right? And one of the mandates of keeping inflation under control seems to be very certain, and especially with the move that we've been seeing in commodities this past week. So it's all growth dependent now. Now it's going to be about, are people, is the labor market strong still? And it's been definitely weakening. Like you could see, like what he pulled up there, job openings. I am curious to see how this is going to be affected by all of the government layoffs. As there's more people out there looking for work and taking jobs, how is this chart going to be affected? Are we going to dip further below the pre-COVID highs? And this is what the Fed's looking at as well. They look at this as a way to front run the unemployment rate.
Yeah, so I want to be pretty clear about this chart, right? Like, let's be very clear that we are historically, since this data has come out, we have not seen recessions form without this ratio going below 1. Essentially meaning that there are more unemployed people than there are available jobs if that ratio is below 1, right? And this doesn't go back very far. The job opening, like the jolts and stuff like that. It doesn't go back. I think it only started in like 2001 ish, something like that. We don't have like jolts data into the 80s and whatnot. So it's hard to track going back in time like that. But ultimately, what we need to understand here is just the basic economic concept of, if you have people entering the workforce basically because they've lost their job in, say, the government, right? You have to be able to absorb those jobs. Otherwise, you're going to just increase the unemployment rate. Now, given that the ratio is above 1, basically there are more job openings than there are unemployed people. What this tells me by looking at this is there's a buffer here to absorb some excess labor that comes online from the government or from downsizing, even at other companies. If some companies want to downsize, there are other options that, the labor market can churn this out for some time here before we start seeing some, real significant damage being done. Now, obviously, this goes below 1, things probably start to deteriorate more exponentially. But until then, I think there's this possibility that the market can almost absorb this. So you have this scenario, right, where you have what most would consider less productive individuals. And this is not a rag on anybody, but less productive job roles in the government, right? I don't want to say individuals, more job roles. and people being relieved of those job roles, if they enter the private sector and the private sector can absorb them successfully, what's going to happen is productivity is going to increase. Now, you have to take this with a grain of salt. There's a margin, right? You can't have the government and the private sector running full blown optimizations all at the same time, laying off everyone and expecting like the job market just to magically or the rest of the labor market somewhere to magically absorb everything. So there's this buffer that, depending on how things progress, and we're gonna have to see that as we go along here with the monthly jobs numbers, that will be the key here. And that's why I'm thinking that I'm pretty confident in saying that the labor market is now the barometer that everyone needs to watch out for. So um, I think this also ties into pretty much the plan we've been seeing coming out of the White House lately, man. Like, it's pretty apparent that they're almost saying all the wrong things if you're pro risk assets right now.
Yeah. It's as if Trump wants to fix this deficit problem, bring the country into a recession to fix the inflation problem, and then build back from there over the next 3 years. That seems like
I
his game plan.
Yeah, and what's fascinating about this whole thing to me, right? Number one, there's a wide range of possibilities. So, like, for example, Trump saying that he wants to balance the budget by next year. It's possible. It's not probable.
Well, there's going to be a lot of pain to get to that point.
Right, but like the way that the path of which that happens is it's not impossible, but it's very improbable, right? The amount of spending that they have to cut to get to that target. Now that it could happen.
Well, yeah,
So,
especially over the span of a year as well. That makes a difference too. Like if you can do that over the span of 4 years, it's a lot more manageable than doing it in 1 year. There's going to be a shock in the economy.
right, but now this is where my, I guess, my intuition comes in, right? Because the Cent is looking for 3% deficit, right? Essentially, 3% deficit, 3% growth, right? Something like that. Well, if you balance the budget, you're essentially bringing deficit down to zero, right? But given that the Fed right now, if we look at the Fed on a, let's see, pull that up. So, or let's look at the Fed here, right? And let's look at 2-year Treasury yields. Let's give us some perspective. Okay. Okay. So right now the Fed's at 4.3%, and the 2-year Treasury yields at 4, basically indicating that there are rate cuts that are coming. There's rate cuts to be expected over the next 2 years. Very simple to understand, right? Now, the question here is, the Fed's already in a restrictive state. We're seeing that. I think we all understand that the inflation's gone from 9 to 3, and in the next few months might even be 2.25, 2.5, right? So we're talking about being a quarter to 50 basis points above the long-term inflation target from the Fed. So obviously the Fed has been restrictive enough. QT, balance sheet runoff, they've been sucking liquidity out of the economy. The question here that I think we need to wonder is, if the government remotely gets close to balancing the budget, what's going to happen is the Fed's going to have to run an immense cutting cycle, because they're already restrictive, and they're going to have to recalibrate for that shock in fiscal. Now, the reason why we don't run a surplus in this country is because there's no the government hoarding capital is very inefficient, right? So the government sitting on positive surpluses is a constriction on the economy. The government could invest that money. Yes, they have to borrow. They owe on this money, but they could invest that money and essentially have a positive output to GDP, rather than just sitting on the money doing nothing, right? So if the government balances the budget, what essentially was going to happen is you're going to create a recession in the process, because you're going to take away all government spending, all government stimulus from the economy, and that government stimulus that we've been seeing, that excessive 5, 6, 7%, 6% deficit right now, that has been offsetting the Fed's restrictiveness. So if you reset the government side, the Fed needs to reset as well. Otherwise, the Fed will actually be overly restrictive in the process. And this is if the government can get to a balanced budget, which again, very improbable. But hypothetically, let's say they get there. What's going to happen is the government's going to create a recession that they were going to have to then go back into deficit for. Because in recessions, the government goes into deficit to basically stimulate the economy, right? To help aid in recessionary gaps.
Well,
So this
can
idea,
they put that responsibility onto the Fed?
no.
It has to be both, the Fed cutting and a deficit at the same time.
So it's somewhat similar, right? Because when the government runs a deficit, right? Essentially, what they're doing is they're borrowing more than they're bringing in, so they need to issue more debt, right? So the Fed essentially is propped with this position of quantitative easing, right? Where they go out and they can buy treasury assets. If the government's not issuing enough debt, right? There's not going to be enough securities for the Fed would basically just crowd out the treasury market. If the government slows the issue of debt down, right? The Fed is stimulating the economy by buying the government debt,
Yeah.
essentially, right? Because they're holding the treasuries. So it's a very the government needs to get the treasury issuances up for the Fed to buy them, right?
Yeah.
Now that's where the issue has been right now, right? Like so the Fed's done QT, they've been slowing they've been letting their balance sheet roll off, and the government's still issuing this debt, but the Fed's not buying it. So what you've been seeing is we saw, right? Long end yields have gone up, and if the government doesn't fix the deficit at some point, the long end yields will continue to rise. And I think that's a big factor we've been seeing happening here on bonds, right? If we look at bonds, bonds made a violent reversal off their lows pretty much ever since inauguration on this back of that the government's going to fix the deficit, right? And inflation has slowed with tariffs. And you have a combination here. You have government that's very proactive about cutting spending. You have tariffs that are going to slow growth. So everything's like negative yields, right? Like you have somebody coming in basically saying, like, again, we said this earlier, it's almost like the government wants to instill this recession, at least early on in the administration, and then come out of it on a healthier footing. That's at least the way that they portray it without saying it exactly.
Yeah.
And I think that the issue you're going to have is the government's going to, if you have this government plan of cutting fiscal down to zero, balancing the budget, well, the government's going to have to go back into a deficit because, again, the government is a part of GDP, right? So the government spending is a part of GDP. So the government has to contribute to the government has to invest in itself, basically, and it does that via deficit.
And at the
So,
moment, bonds are very fragile towards tariff headlines. Like I noticed this sell-off that we've had was Trump walking back on some of his remarks on his tariffs. And that's what caused these bonds to sell off because tariffs essentially are the way that he's planning on reducing the deficit. And so if he's walking back on tariffs, that's bearish for bonds.
oh, absolutely, because again, it's also going to not dampen growth as much either, right? Now, that's something that I think ultimately the administration is in a pickle here because for them to get the cuts they want to get out of the, like, okay, if you think about it like this, the deficit's 1.8 trillion, right? Half of the deficit is interest payments. If you think about it, like if you removed interest payments from the federal expenses, you would cut the deficit down in half. So you would basically go from a 6% deficit to a 3% deficit if you paid 0% interest. Well, obviously the government's not able to do that, right? So the way to fix the deficit is to become fiscally responsible in other areas, right? So basically think of the deficit a reflection of your spending habits and the interest rate, your credit score, right? If you have a poor credit score because you spend money without remorse or basically recklessly, right? And you end up in a situation where you have a poor credit score and you have to pay higher interest. Well, for the government to fix the interest component of their debt structure, they have to increase their credit score. So they have to fix the deficit and they can't fix the interest component of that. So 50% of the deficit can't be fixed because it's interest related. And the only way they can do that is they can lower interest rates. Well, how are you going to lower interest rates without dampening growth enough to merit it or becoming more fiscally responsible? You can't. So, or I mean, there's obviously another way. You just don't pay, but that's a default, and that's not going to happen, right? So,
Yeah.
so you're in a position now where if this government wants to be serious about fiscal responsibility, 50% of that deficit value they can't fix unless they become fiscally responsible. And to become fiscally responsible, they need to do things which they're also not doing. Like, they're passing these tax cuts, right? If they were fiscally responsible, they wouldn't do that. They would leave the tax cuts, they would leave the tax structure in place, let the tax cuts expire, put tariffs on, and then reevaluate thereafter. Instead, what they're thinking, and this is based on the commentary that we're seeing, is that they can pass these tax cuts and they can make up for it in savings. And they can get the tax cuts delivered, basically no promise that's not kept type of thing. They can deliver the tax cuts and then they can figure out how to offset those tax cuts later. When in reality, what they should do is they should fix the deficit. And then, if you have the deficit you fix the deficit because you fix the spending problem, then you can worry about the revenue. Then you could say revenues are too high. Let's cut the revenues, right? Instead, they want to cut the revenues and then hopefully find the cuts in the spending, which again, remember, if we're at a $1.8 trillion deficit, 900 billion of that is interest. Nearly $1 trillion of that is interest, which they cannot cut. So it's a very peculiar situation for the for the government to balance the budget in 2 years. It's just something that the amount of money that they would need to bring in from tariff revenue is immense.
Yeah.
And
And so far,
look
it's
at
not working out too well.
look at what we're doing with tariffs. They're on today, off tomorrow. You know what I mean? So it's like, again, very interesting times ahead. If the government wants to be fiscally responsible, they're going to have to start doing uncomfortable things. And if this administration is really gung set or set in their ways of bettering the deficit, unfortunately, I think everyone's coming to the realization that that is not an easy path. That's going to require some economic hardship. And typically economic hardships are mostly felt by the lower class of society, right? That's going to have to be a consequence. It's not the ideal, it's not the wanted, it's not the wished upon, but it's going to be the unfortunate consequence of the government saying, you know what, it's time to be more responsible. And yes, there's waste and fraud. I know that this is something that like everyone's like, oh yeah, we're gonna find $500 billion of waste and fraud. Is it possible? Probably, but like let's be honest. For the government to find $500 billion of waste and fraud, we're almost 3 months into the administration, and Doge is just getting roadblocked. We have 100 billion of cuts that are of spending cuts that are expected, but we have yet to see where that materializes. We're hoping, obviously, everyone hopes that we can reduce this waste and fraud and nonsense. But the question is it going to be enough? Because remember, what's going to keep climbing? That interest expense.
Yeah,
That
it's
interest
just a
expense.
ticking time bomb.
And this is no doomer talk or anything like that, right? Just let's be real here. The government can very well run a 6% deficit, and it'll climb, and it'll take some time. It'll take many years, but before the government's in like the it's so over bucket. Like, we're not there. Like, you shouldn't be, saying like, "Oh my God, like this is the end." That's not a terrible way to look at this. It's probably the worst way to look at this. What I
Yeah,
would
it's
say
like the
is,
Peter Schiff way of looking at things and just dumping
yeah,
your entire net worth into gold.
yeah, like what I would say is that we're at a juncture right now where if the government wants to execute the plan that they've voiced to execute, it's going to require a withdrawal of economic stimulus, because that economic stimulus is basically the extra expense that you're seeing on the deficit. That's that deficit value, whatever, $1.8 trillion is the economic stimulus that has to be taken down. And there's there's a weird way where they can do this, where they can actually fix the deficit, right? Like if the government cuts some spending, GDP just simply has to rise faster than the debt grows, and therefore the government would theoretically offset the deficit without having to like balance the budget. They have to spark immense amount of growth and moderate the spending levels, and GDP lifts, bringing down the percentage of deficit of GDP down, right? But again, how you do that in a situation where the Fed's in a restrictive state and everything is very tilted towards this not working out, I'd be surprised. That's the most unlikely outcome, right? Given how fast the government is trying to cut costs everywhere. That's a very even seesaw that needs to be executed. Deregulation, tax cuts, inspire growth, push the
I think he's
economy up.
hoping with the tariffs that it would boost growth, bringing jobs back to America. I think that's his
Uh,
plan for doing that. But you do need the Fed to cut rates at the end of the day. Growth is just going to struggle.
yeah, and it's a very interesting dynamic, but I think ultimately, right, like we talked about how this isn't good for the asset markets. Like, let's just look at Nasdaq here. And Nasdaq could very well go back up to all-time highs at some point in the next couple of months. But we're at a juncture now where it's pretty simple. Nasdaq below 500, it's 100% risk off. 100, like one. There's no, at this point, if this continues, the trend will flip within a week. Within a week and a half, one to 1.5 weeks from now, this will be in bearish trend at this point, right? We're too far below Momo. This looks like it's gonna possibly even go lower. We'll see. But at the end of the day, if we're above Momo, then trend can stay. If trend can stay bullish and we go back above Momo, our prior case of just bullish trend chop can continue. For this thing to really send it and really go like on a bull run, as some would call it, we need risk on. And right now, risk on is not looking too hot. So until we get some resolution on that, on a risk dynamic shift from risk off to risk on, the base case at this point is going to be chopping sideways until we're bearish trend. And when we go bearish trend, the base case is always going to be lower. Like, for example, bullish trends tend to lead to higher prices. When we're in a bullish trend, we always say the base case is going to be higher prices as long as we're above the mid vamp. So a good example using DDAP is, as long as we're above mid vamp in a bullish trend, base case, new highs. Very simple. As long as we're below mid vamp and the trend's bearish, base case is new lows. So if we flip bearish again, that is not a good sign for risk assets. This already isn't a good sign. We could bounce, possible. But as long as we're below Momo, that is the wall. That's the line in the sand. And TLT kind of has that opposite look. TLT has been bearish trend. It's been putting in a nice counter trend move here. We're back up to Momo. As long as TLT is below Momo, the trend's not going to flip. So what's going to happen is this is going to end up being one counter trend move until we can get above. If we can get above, the risks start exponentially rising that we flip the trend. If we flip the trend on TLT, the odds of higher prices are much higher. Until then, this is basically just a bear market rally. I gotta say, man, we definitely this move so far has bagged a lot of people. A lot of people got like basically snaked into this.
Oh yeah. Which it's I mean, this is a better time to buy bonds than we've seen before. So I'm pretty bullish on bonds, but obviously at the end of the day, we do need to get that bullish trend. You never know what's going to happen. Like we were in love with XLU. We couldn't wait to buy XLU, and now look at that. That thing completely reversed.
We never bought this.
No, we never bought this, but we wanted to.
Oh, we did originally, I think, right? We did
No, we got that neutral pivot, so we never actually ended up buying utilities. That
right,
neutral
right, right,
pivot
right.
saved us. It was we missed a bit of a rally, but we wouldn't have taken profits, so it worked out. DDAP saved us there in the end.
Oh, that's right. That's right. I remember now. Yeah, yeah. So we didn't end up actually buying this, and in no, dude, I'm pretty sure we did buy this. We bought this for like a day.
Did we?
Mm,
Maybe.
Yeah,
I think
yeah,
you're
no,
right.
no,
I think you're right. We
we,
did buy it for like 2 days.
no, we bought it. We bought it here, and we literally sold it here.
Yep. Yeah, literally
Yep.
2 days.
And it went up, came back down. Funny enough, XLU is pretty much back to the same price we sold it in January.
Yeah.
It's gone
it's
absolutely nowhere.
it blows my mind how the system can pick up not only the regime, but also is it worth, like, is there going to be a long enough and strong enough trend to make it worth it? And in this
Well, what
case, it didn't think so.
Well, just remember that we also like let's take a look at the system, right? Like let's look at where we are right now. We are in risk off. Like so this is the slowdown barrier and this is where we consider longing utilities healthcare. Below the slowdown barrier, we don't touch them. So if we go back on a weekly chart here, just the last like 3 months. Like let's just take a look, right? Look at this. We fell below, I believe it was here. We left on 212. So basically, we left the slowdown mid February. If you look what happened, 212, right? Yeah, we went up a little bit more. Like we literally left the optimal regime to own utilities here. And since then, they've gotten nuked.
Yeah. Pretty wild.
So pretty wild how this works. Like obviously, yeah, we didn't long this. What we did for a day or two, it was a small scratch, but at the same time, like like you said earlier, there wasn't enough momentum to get this thing going, and we flipped out of slowdown so quick that this is just undesirable at the moment. Like, could we eventually go back to a slowdown and be long utilities at some point? Absolutely, but again, they need to be bullish trend, and we need to be in a slowdown.
Yeah.
We are
I
not
think
in. We're
that's I think the way this is going to play out is we're probably going to pivot to deflation. Like the inflation index is getting pretty close to bearish trend now. We're going to pivot to deflation, and then eventually growth is going to bottom, start working its way back up, and we might get a little window of slowdown in there before going back down to risk off or breaking up and into a risk on. That's likely what's going to happen, but I think there is going to be another slowdown period in there as we get up out of this growth, whatever you want to call it, this growth decimation that we're in right now.
Well, the one positive there is if given XLV healthcare is in bullish trend right now. If we get a move into slowdown, we do have the option of going long healthcare. That's one outstanding possibility right now. Given again, bonds bearish trend. We don't touch them. Like, listen, I like you, man. I think we both our balls were tingling for these things, man.
Yeah.
Listen, I like we were like, oh, like you. I think it was this day. One of these days, it was this day here. It was on Wednesday. Like we were so close to getting like one solid up day, one day like Monday at some point in the middle of the week this week. We probably would have been triggered into the bond trade. Didn't happen. Faded. And honestly, we were expecting to get long bonds in the next like week. We were thinking that. Both of us were like, oh, you know what? We're gonna get long bonds here. This is gonna flip bullish trend. Probably gonna put in some type of like leg higher. And sure enough, it gets dumped. Now, NFP's tomorrow. This could very well gap up tomorrow and start it's this is make it marking like a higher low and starting a leg higher. But we will not touch bearish trend bonds. Not gonna happen. The only thing we will touch in a bearish trend is Bitcoin if we're in a slowdown regime. I mean, in a risk on regime, sorry. If we're in risk on and Bitcoin's in a bearish trend, we will hold it or buy it. It's the only thing that moves so quickly that you need to be allocated. Otherwise, you actually end up missing large chunks of moves. But Other than that, we got NFP down the pipe tomorrow. We'll see what happens. Ultimately, estimates of 160. We'll see where we lie. Market is very beat up into the print here. Possible we could see some sort of gap. Again, equities on QQQ, line in the sand is 503, 504. Anything below that, straight up bearish for us. Thank you guys for listening, and we'll see you guys next week.